All right. Good morning, everyone. It is 9:05 in the morning of May 3rd, 2022, and this is my pre-market strategy session. The title to today's video is, what did I name it? Something like rate height. Oh yeah, Federal Reserve rate height, rate expectations. So the Federal Reserve is in a rate hiking mode, and the market is pricing in 10, as of right now, the market, according to Bloomberg, the market is anticipating 10 rate hikes between now and December of 2022. So the next 8 months, the market is anticipating the equivalent of 10 rate hikes, equal to 0.25 percentage points, 25 basis points per hike. So that's 2.5%, basically, is what they're expecting, and they're calling it 10 rate hikes. So let's just do it this way. 0.25 times 10, 2.5% rate hike over the next 8 months, and that could come in the form of, I don't know, 3.5% hikes, and then 8.25% hikes. I don't know. I don't care, really. I think there's a snowball's chance in hell that the Federal Reserve will actually be able to raise rates 2.5% between now and the end of the year. And this past quarter had shrinking GDP. The gross domestic product of the United States was negative 1.4%. I've never seen or heard of a Federal Reserve that is going to rake heights into shrinking GDP. But who knows? Anything's possible. I think that as rate expectations come down, we'll see a little bit of leveling off in the market. As of right now, though, we have a new closing low here that was on the 29th of April. I'd completely forgotten. In fact, actually, it's on the Qs, I should say. We have a new closing low on the Qs. And I'm not quite sure how it escaped my attention. I think that I was looking at a weekly chart. But this little combination right here, this little combination right down in here is extremely bearish. And I don't know how I missed that. Here's the closing low over here that happened on the 14th of March, 2022. And back here on the 26th of April, it closed below again and then confirmed on the next day. Then there's, you could call it, if anybody was short, I think if I had known, if I were for whatever reason, I wasn't paying attention to this right here. However, if I had known, I would have been comfortable having held put options overnight right here. A close below on the previous day and then confirmation on the next day is extremely bearish. And I probably, if I had realized this was happening, now I'm glad I didn't, of course, because the next day would have ripped my face off. If I had let's see what the close down here was at 316.76, and then it closed the next day at 328, 12 points higher, 3.5% gain on that day. That would have ripped my face off. Or, I don't take risk enough to have my face ripped off, actually, but that trade would have been a loser, and I probably would have said, F this, I'm out of this trade, and cut my losses when I could, and then not wait not wait for the 29th of April, which turned out to be a pretty big down day, 4.5% down. So yesterday, let's see. Yesterday, I was looking for bearish setups yesterday, and I did get one. So you can see here, it opened here. Let's see, the opening price was at 312, and I got right here. I got an opportunity when it broke back down below 312.95. I got into a trade. Now it didn't continue. You can see here it broke down and went back up again. And so I got out of the trade, with profit, but not with a hell of a lot of profit. Not like on a day where it broke down, here on the 29th. It was a pretty good day. So now what's happening is there's yesterday's close towards the end of the day. This is kind of the pattern here. This buy up into the end of the day, this is bullish. It means big money is coming in, institutional types are coming in. The pros close, as the saying goes. And so, there's a 2.6% rally there between 1440 and 1600 in an hour and 20 minutes. So, and that is usually indicative of institutional buying, some kind of, big boy buying. You can see the volume here at the end of the day too. My volume is. Oh well. Anyway, you can see volume came in at the end of the day and really picked up. So I kind of I wouldn't be surprised to see. There are the shorts. Let's look at the short call ratio here real quick. The put to call ratio. It's not too terrible. It's not. Well, the put call ratio isn't really high. It was kind of high over here. Let's see. PSSP. Yeah, this is on S&P. Right. And then it changes all the time frames here. Let me change it back. So, I wouldn't be surprised. It would make sense to see a little bit of a bounce off of the bottom here. The S&P, did just recently make a new lower low here on a closing basis, it's just the way things work. It makes a newer low. It comes down, makes a newer low, bounces up. Comes down, makes a newer low, bounces up. Comes down, makes a newer low, bounces up. Much above this 430, 431 level right here. I'd be surprised to see price action go a lot further higher than that. And let's see, the VIX, the risk range on the VIX right now. Actually, let me look here. Risk range on the VIX is 37, so the top end of the risk range is coming down a little bit on the VIX. 37 dot, let's see, 98. So it's coming down just a little bit. And then the bottom end of the range is at 24.88. So the bottom of the range has come up a little bit. So it's bearish. Sentiment is still bearish. I think short term, we'll probably see the VIX, come back down to this level, and then start running back up again. So I think it's safe for the time being. I think it's safe for the bulls to come out. It's probably a good time to take advantage of the relief rally that happens here and then once the VIX starts getting back to the low end of its range again, then start looking for bearish opportunities. So today, generally speaking, although we are in a bearish trend, I am going to be looking for bullish setups. All right, everybody, good luck out there. Keep your wrists tight. Click like, share, subscribe, leave a comment, tap the bell, and I will see you at tomorrow morning's strategy session. I am out.